I'm your host, Xiao. I'm a principal on the venture investing team. Today, our guest is Patrick Fitzgerald, who is a partner on our team. Welcome, Patrick.
Thanks for having me, Xiao.
Yeah. So, today's topic is about, corporate venture capital investing or CVC investing. But before that, Patrick, you have so many different experiences, a different side of the table. Why don't you give an introduction of yourself, your role before, and also what you do here at Mach 49?
Sure. So I'm a partner on the venture investing side at Mach 49, where we help companies launch, refresh, or refine their corporate venture capital practices. In a prior life, I was a founder of a few very successful startups and a few very unsuccessful and miserable failure startups. So I've lived that life as a startup founder. I've also been teaching at the Wharton School of Business, an entrepreneurship class there for about 14 years. And in the past decade is when I started to focus on corporate venture capital at places like Bank of New York and Children's Hospital of Philadelphia, where I helped lead those initiatives.
Yep, thanks. That's a very interesting background. So let's actually start from sort of ground zero, right? So what is a CVC and why does a corporation ever need one, right? Why can't they just do, let's say, ad hoc investments?
Sure. So a corporate venture capital fund is basically that. It is a fund designed to live with inside the corporation that allows that corporation to invest in outside entities, more so in the minority stake. Obviously, certain entities and companies have M&A departments where they go out and buy large stakes in companies or buy them outright, whereas corporate venture capital allows those corporations to make small bets across a variety of companies over time, like a traditional venture capital firm would do, but under the umbrella of the mothership is a term we use. Why do companies have a CVC? Certainly, there is a financial component to this, that companies would like to make those small bets and have nice big returns with those. And that is certainly a good enough answer as a why.
Yeah.
But the reality is, because companies have other focuses and primary focuses, if you will, the role of the CVC group is not only financial, but to bring back some strategic value and learnings from investing in those companies at the early to mid stages, so they get a sense of what the future may be like for their company, and also to help their employees get to understand new technologies, new services, new products, potentially before their competitors do.
Yeah, thank you. That's very thorough. So just kind of delve deeper into this, right? Any company can build, buy, or partner or invest, right? So I guess you talk about some of the points where we can say, hey, there's some strategic insights we can bring back to the mothership, but then why can't they do that through, let's say, a partnership?
So the CVC angle and benefit is a longer term horizon, to be involved with companies over the life of their existence, and to kind of help them grow, but also to grow with them. When you have a partnership, there is value to that, don't get me wrong.
Mhm.
But it's not as in depth, it is not as sort of tied to the hip, as you will. If you like a startup and maybe it's not a good investment, but it's a good partner for your company, that's certainly an angle some companies take. But and some companies actually have both, right? Where they say, hey, we have an investing arm and we have a partnership arm, and the partnership arm is completely free and clear of the investing. It's hard to pull off because over time they start to meld into each other. But the investing just allows you to get a much deeper insight into the future of your industry.
Absolutely. So we're gonna delve deeper into some of the nuances there. You mentioned about investing, strategic financial return, partnership angle. But before that, now let's actually talk about how do we build a CVC, right? So obviously there are many different angles there. Let's start with the North Star, right? So we have heard there's the North Star is, strategic return or financial return, right? Is that an either or relationship or is it kind of like both? How do you actually balance that?
So, at Mach 49 and both in my own career, we've seen all different flavors of them, right? The ones that are sort of triple down on the theory of early stage or mid stage investing in startups as a function of CVC, combine the financial return and the strategic value. And if they can pull that off, right, the learnings go both ways. The investing goes both ways in terms of, growth and equity in a startup and the potential return. And look, if you invest in a company and let's say you get a 5% ownership stake, but you get all that information and learning as you would because you're on the board of this startup, and over time that company gets super valuable and your equity stake grows and you're helping that equity stake grow because of the partnership that you've created for that startup, right? That's a win-win-win for everybody. That is a challenge, right? And that's something that we do at Mach 49 is because that's new language and sort of a new way of doing things. It's not for everybody. And certainly for us, our goal is to help companies understand why they're doing it, because Xiao, that's probably the most important part is at day one is why are we doing this? What's the point, right? And if you can answer that and get to sort of a fundamental belief, then hopefully everybody at the company starts to understand why we're doing it. Not just, hey, we want to make money because, we sell shoes. We already make money selling shoes. We don't need to do this. We need to understand what, a why is.
Yeah, absolutely. So to that point, right? So as you know, many prospects or existing clients come, initially came to us saying, "Hey, I'm actually in this position of thinking whether or not we should actually launch a fund, the first fund ever as a CVC fund of our mothership organization, right? What are some of the suggestions or thinking processes you would actually give them to help them make the decision? Maybe not always a yes, but then like, hey." Maybe teach them or help them how to think about the process. Hey, do we do that? Are we ready for that? If we were to do it, do we do it alone or do we work with someone else, right? So what's the thinking process there?
Right. There's a lot of questions and sort of cultural understandings that you have to get to the bottom of before you launch a CVC, especially for us coming in from the outside. We have some clients that say, hey, we're too conservative. I don't know if we should do this, but I don't think that's fair. Just because you have a conservative, maybe less risky appetite, that does not mean you should not have a CVC. But the question, one of the questions we would put out to is, what is the appetite for failure? Because traditional venture capital, there is a good amount of failure. You're going to make 10 bets a year and 6 of them aren't going to do well, if you're lucky. So what does that look like from an appetite perspective? What is the sort of business unit buy-in, right? If the business unit kind of looks at corporate venture capital as, those crazy
Business
people,
yeah.
The business units might not want to help, right? And I think understanding the executive buy-in, not just from the CEO, but from all the different division heads or department heads or whatever it may be that would touch that startup. If they're on board and they understand why we're doing this, then that's only going to make your investment more valuable. So a lot of those kind of questions are going to need to be handled. And then, lastly is the people, right? Most likely you do not have someone sitting in the building somewhere who has a lot of venture capital experience and you can say, okay, Sally, you're in charge of venture capital tomorrow. You can't do that. You have to think about who do we have the right people internally and externally who can teach us about this new world and kind of pair the two together. It's very rare to just kind of pick somebody internally who can do that.
But then like they tend to do that, right? So they tend to, well, you got to have a starting point. You have to have some internal champions there, and maybe using our terms, the CVBD person who can really functionally acting as a liaison between the CVC team and also the business units there, right? Let's talk about talent, right? So there's VC, there's CVC. We definitely have some insights there. I wonder, like, hey, how do we attract talents there, right? So why should someone who is like from a top tier VC firm decided to join, this newly, founded CVC team or not? Or how can we attract them?
Sure. So what I like about CVC from a talent perspective and what drew me to it is you can, if you do it right, when you make investments, not only can you help companies with capital, but truly you can help them with some, foundational expertise from your industry that you can help grow that company, right? So look, I could be a venture capitalist and make a bunch of different bets and just hope the money sort of grows in some way. But the power and again, if done right, of CVC is what if you could actually invest in those companies and then help those companies grow because you were one of the leaders in the field of, let's say, shoemaking again, right? If you're one of the leaders in the field, you can help that startup exponentially, more so than any traditional venture capital firm can, because they're honestly just looking at the bottom line and whether or not you're going to return 10x in 5 years.
Yeah, exactly. So let's talk more about that mothership support later. But then like now going back to the fund, right? So we put together this fund, really. So there's the decision-making process, there's the talents there for the core CVC team. There's also the investment committee, stuff like that. How we sort of the themes of the fund. How do we start, right? So like we know the mothership, we kind of have some initial buy-in from someone who is a champion, reach out, let's say, to an external party like us, helping them start. How do they start, right? So how do we choose like the topics to start, sort of like the font size, and then who is going to be on the investment committee, right?
Sure. So you certainly have to have limits and boundaries when you're creating a corporate venture capital division, right? Geographic limits, the size of the checks you will write, the types of industries you're going to go in, how early or late you're going to make investments. All those questions for sure have to be answered and sort of codified so everybody knows, hey, we are only doing Series A companies in the US that do these 5 or 6 things. If they don't do those, we cannot do it, no matter how exciting it can be. Right. So sort of land on some of those rules. When you think about the investment committee and who should be involved, certainly having some C-suite folks involved on the investment committee, not making the decisions on a daily basis, but just being able to kind of understand the entirety of the business and whether or not making those investments make sense. And can the mothership help the startup? I think that's super helpful. But also you have to have people in the investment committee and those generally speaking on the team who are willing to do the dirty work, right? Because making early to mid-stage bets at a CVC is not something you do sort of on the fly. You have to kind of follow that roadmap and follow that path. And it takes a little bit longer probably, right? Because you have some legal hurdles, et cetera. So people aren't afraid of hard work and actually sort of roaming through the halls and getting all the boxes ticked that you need to get an investment approved.
Okay. Yeah. Yeah. Let's also talk about some of the maybe best practices of, let's say, how many people do we have on the IC? What is the decision making like? What is considered as too long? And there's also words on the street saying, "Hey, I don't want to work with this CVC because so and so," right? So some commonly heard challenges or maybe best practices.
Sure. You think about 3 levels of administration, if you will, right? Typically, a CVC will have a board, which meets maybe once a month. And that is just kind of making sure that everything is even and everything is done right and done proper, and you're following sort of those initial rules that we set at the beginning. The next layer down is the investment committee, and they most likely meet on a weekly basis to look at existing portfolio companies they've already invested in, or new deals and new potential investments to say yes or no. The ones that do it right follow that cadence, right? Maybe once a month for the board, once a week for the investment committee to approve, deny, monitor the investments. Below that, right, is the investment team. So that company's job is to go out and find the companies, negotiate, due diligence, source, network, so that that deal flow can come up. The investment committee can make decisions, yes or no, and over time the board can say whether or not everybody's doing a good job.
Yeah. And how long does that process take, or how long it should take from your perspective, right?
Well, from the investing team perspective, that's constant, right? They should always be out there finding new opportunities, finding new investments, and they should be very clear with the startups. Here's our process. Let them know we're not a traditional venture capital firm. We can't just have a partner meeting on Monday and everybody says yes or no. We have a system, but if we go through that system of our due diligence and our negotiation on the investment team, then we go to the investment committee once a week, right? If you can follow that cadence and kind of go through that process, it's probably not going to happen as fast as you want it. But if you understand it up front and you understand the value of what a large corporate can do for you as a potential customer and partner and investor, you're willing to go through those hurdles.
Yeah, absolutely. So sounds like the thinking here is, let's say if I were to raise money, I work with a CVC. I understand it's going to take longer than a traditional VC, but then there's also like some added benefits, like, hey, I can work with their mothership business units and stuff like that. And then we understand, hey, it's going to take some time because, you have to, find the internal champion for this deal to go through. That's all that, right? So then on the other side, and kind of trying to play, devil's advocate here, I've worked with many founders, I've worked with many CVCs and VCs as well. Definitely have heard of, situations where, decision making is too long for a CVC. 4 to 6 months is really long. Whereas, if you talk to a financial VC, decision making process takes about generally 4 to 6 weeks, right? So, and also there's always the promise of mothership support, but then that doesn't really always happen, right? And then with that kind of falling short, you're kind of in a position as a CVC to say, hey, we take lots of time, we don't really lead, we follow. And then, we have a mothership support promise, but it doesn't happen, right? How do you avoid things like that? Because it's going to make you potentially looking really bad, kind of have a bad reputation on the street.
Well, yeah, and as I said at the top, I've been a founder myself, right? And my first company was in the waste field. It was in the trash and recycling industry. So, I'm 27 years old. I have no understanding of the industry. We're doing pretty well. We have clients around the country. At some point, Waste Management, which is the largest waste company in the US, a publicly traded company, starts to express some interest in us. Now, you can imagine a startup in the waste and trash business when Waste Management comes knocking on your door. That's an interesting conversation, and you have to understand what their objectives are in investing. Why do they want to be a part of this? Well, if you listen to their earnings calls, they are trying to become a greener company, and we were focused on the recycling space. So we understood what they needed, and obviously what we needed was their help expanding our company around the country. So it was a two-way street. It was very helpful. What I also knew on the other side of the coin, Xiao, is we did have traditional venture capital firms on our cap table. I know what they wanted. I know they wanted us to get to an exit by a certain time period. If we didn't, they were going to drop us. Waste Management, that's not what they needed. They have their own business. So the pressures were different, but in terms of expansion, it made sense for us to take that. So for me, that example is, as a founder, what you're wrestling with, just understanding what the incentives are for both sides of the coin.
Okay. All right. So this is really helpful. Obviously, Patrick, we can talk much more in detail about this CVC process, right? But this concludes our episode for CVC investing. Thanks again, Patrick.
Thank you, Xiao. That was amazing.
Yep. Okay. Take care.